Hi, today we are in San Francisco in the SoFi office. Hi Dan, who are you and what do you do?
My name's Dan Macklin. I'm one of the co-founders of SoFi. We are a consumer finance company. We lend money to people across a variety of sources and ways.
Tell us about your background. So what did you do before you started SoFi and how did you come up with the business idea?
So I'm originally from the UK and I was educated there, and I worked for a British bank called Standard Chartered Bank for about 12 years across a variety of functions, but also countries as well. So I spent a couple of years in Singapore working in a risk function. Back in London, I worked directly for the group chief executive, kind of like a chief of staff role, which was a really great way to see how a big 70,000 person company operates. Then I spent nearly 3 years in China running a small and medium enterprise business with a large team across the country. And then came to the US to go to business school. And it was a special program, a 1-year full-time program at the Stanford Business School, the GSB there. And that was back in 2010. And then went through that year, fell in love with Silicon Valley and the idea of entrepreneurship. And although I probably expected to go back to my previous company because I was sponsored by them, we being the co-founders of SoFi, were classmates, and we were discussing ideas for businesses, and one thing led to another, and SoFi was born out of those conversations.
Great. What type of business models did you discuss with the co-founder? Because I guess you had a long list of ideas and then shortened it and said, okay, let's start something in the consumer finance sphere.
We did. There were a few different ideas that went around. One of them was more in the tech space. We were trying to make a kind of eBay for video services. So if you wanted to buy someone's time, but you didn't want to have to drive to where they were, then you could bid $20 for half an hour of their time, and they could give you a tutorial over the internet. We quickly changed out of that for various reasons, and we focused on finance because that was where most of us had come from, and I think that was the industry that we wanted to come up with something to solve. So we had some broad ideas about connecting people with money who could invest and people that needed money who could borrow more, and connecting them more directly and without all of the intermediaries that tend to exist. So that was the genesis really for SoFi, and our first product was in the student loan area. So it was individuals investing money through SoFi, and we then passed it on to borrowers who could borrow at a lower rate than they otherwise would.
And how did you start about entering the market? So in terms of when did you build the platform and where did you first acquire the customers? Did you focus firstly maybe only on the Stanford University because it was easier, you had some kind of access to students?
We did, yeah. We developed the idea through the last 5 months of our time at Stanford. So really from January to May of 2011, we were testing out the idea and researching and interviewing people and getting feedback and looking into the viability of it. By about April, I think we were fairly convinced that we were going to start a business and we were going to try to make this work. So really, as soon as we graduated, we started the company. So we graduated on the Saturday, and 2 days later on the Monday, we were coming in and starting work formally. So we went back for our first customers to Stanford. So many of the MBA students there, the second years had been exposed to us in some way the previous academic year. And obviously we knew some people, and that was a good way to test the market. And we launched a pilot fund at Stanford, really, where we raised money from Stanford alumni and then lent that to Stanford students. But yeah, that was the first one.
Cool. And how much traction did you generate over the first 3 months or so in terms of how many students did you fund, or what volume?
Yeah, we raised money from 40 people. We raised around $50,000 each on average, and that made a $2 million pool of money that we then lent to about 100 students. So they were borrowing roughly $20,000 each. So within 3 months we'd actually lent money. It wasn't just an idea or a project. We were a real lending company by that time. And then obviously since then we've expanded and lent to many more people since then.
And then when you validated your business idea, why do you think the business opportunity existed? Because students' loans is not a super new market per se. It's a big market. But why do you think there was a business opportunity that you could really attack?
It was a little bit strange because we didn't really understand why no one had gone in there in a big way until we did. So just to give a bit of context, there's more than $1 trillion of student debt in the US today, and which makes it the second largest amount of debt, second only to mortgages. So it's more than credit card debt, it's more than auto loan debt. But despite the size of the market, there are very few options for consumers. And about 90% of the loans are made by the government at very standard rates. And depending on when you go to school, which years you went to school, and depending if you're an undergraduate or a graduate, those loans can be very expensive. So we were surrounded at Stanford by people paying 7 and 8% for their loans. And these were credit-worthy people that we knew would be getting jobs and would, very confident that they would pay those loans back. So that's the market we chose to go after. We didn't really understand why no one had tried it before. I mean, it's a government-dominated industry, so there is some barrier there, perhaps. It was a little bit difficult for the banks to play in that space for a variety of reasons, but it was a little bit strange that no one had done it before. So it was almost too good to be true. But we saw no reason why we shouldn't do it, and that's why we went for it.
And why did the banks did not go in there and offered a risk-adjusted interest rate?
It's a little bit confusing because many of the banks in the past had worked with the government. So the banks would make loans, but they'd be backed by the government. So there was an implicit guarantee there. And that and a few other things kind of muddied the water and just meant that it was an industry that they had retracted from. So post-financial crisis, 2008, there were some banks that were in this space, but they came back from it and they retracted. So maybe we were a little bit lucky or fortunate. I don't know if those are the right words, but certainly in terms of the timing, the banks weren't seeking really to go into new lines of business. They were pulling back and concentrating on compliance and regulatory issues that were their main concern at that time. So I think it created that gap for us.
Great. So after you have generated this kind of 2 million of credit transactions, what was the next step? Did you directly, after this kind of traction, raise money in order to scale?
Yes.
Or did you just try to bootstrap?
No, we raised money for the company after that. Yeah. So through that process of lending to those students and raising money on the other side, we showed two things. One, we showed that we could lend money because we had to get a lending license and we had to set up a website and we had to have arrangements with the servicer, all the mechanics that go into that. So we proved that, albeit at a small level, but we proved that we could do it. And on the other side, we proved that we could convince people that this was a worthy investment and they would trust two things: us as a company to handle their money, but secondly, the quality of the loans they were funding, the quality of the people they were lending the money to. So both of those things we proved out, again, albeit at a very early stage. So on the back of that, we raised money for the company. So this would be really 5 months into the company's existence. We raised a seed round, an A round. I never quite know kind of where the distinction is, but it was a $4 million round. Yeah. And that then gave us the ability to go and start hiring people and start being a bit more aggressive in our growth and our growth ambitions.
Then today you have more of a broader product portfolio. Can you elaborate a little bit on that and what type of customers you are targeting with it?
Sure. So since those early days, we expanded the schools in which we would lend to. We then expanded to lend to people who had graduated from school. They may be 2 or 3 years out, but they want to refinance their student debt. So that was the bulk of our business for maybe the first 3 years of our existence. And then we expanded, as you say, to other products. So we then started to offer mortgage products, but mortgage products that are different to what the market is offering. So many things, but one of them is that we only require a 10% down payment with no mortgage insurance. So something that's very different to the market. Also personal loans. So many people are using this for one-off purchases or maybe to refinance credit card debt, very expensive credit card debt. And we're seeing great take-up of both of those new products as well as our existing student loan business. So now we have 4.5 years into the company, we have 3 very large loan products, and we're seeking to go beyond that as well, beyond just making loans, and seeking to help people in other areas of their financial lives.
Then, so before you started having no debt on the books, because you have this kind of marketplace between investors and people who are looking for some kind of financial products. As you extended your product portfolio, is this still the case, or are you, for some parts like mortgage, also taking also debt on your books?
We have a bit of a complex model. It's like a hybrid model. We actually make all the loans from our own balance sheet, and then typically 1 or 2 months into that loan, we would the loans would be bought by an investor. So that doesn't change the relationship between SoFi and the borrower. Their relationship is still with us. They still owe us the money. If they have a question about how much do I owe this month, they call us. But the economics to that loan are owned by another party. Yeah. And that's really a way for us to be able to scale more quickly. If we were just using our own balance sheet, it becomes difficult to raise that money. And frankly, we wouldn't be able to keep up with the demand that we see for the loans that we have. So they're on our balance sheet for a short period of time, but ultimately the bulk of those loans are sold to other investors.
And those other investors, are these mainly companies like banks, or is this a big bulk of individual investors?
It's a variety. There are still individuals there. We have individuals investing their own personal money, but we found in our early days that was difficult to scale, to keep up with the demand for the loans. So we've complemented that money from individuals with money from institutions. And those institutions are financial institutions, primarily small banks, regional banks, bigger banks, state-level banks, along with pension funds and hedge funds, not-for-profits, a variety of places, but the common theme being that they see the value in the loans that we're making and wish to invest to earn that return.
And how are you credit scoring the people and making sure that you're earning some kind of a premium before you're selling off the loans to other parties?
So we do have a very different approach to assessing people's credit than traditional banks would look at. So we're much less reliant on your credit score, and actually it doesn't factor into our decision, your score itself. So we look more at whether we think you have enough cash to pay back the loan, which sounds very obvious, but it isn't how a lot of the industry works. You know, a lot of the industry is very much looking at your credit score, which may be high or low for different reasons, and we don't think it's a very good predictor of somebody's ability to pay back in the future. It is a predictor, but it's not the only one. So we look at a variety of things, but ultimately it's, do we think you have enough money at the end of the month to pay back the loan? And that will depend on a variety of issues. But we've made over 60,000 loans today, and we've only had 5 people default on those loans. So 4 of them unfortunately passed away. We have something in the small print that says if you pass away, we can wipe that debt. So it's extremely low, the default rates. And we're still early as a company, so we're not claiming victory just yet, but it's an encouraging start.
And how do you acquire the students, for example, for the student loans?
So most of our loans now in the student loan area are refinancing student loans. So they aren't necessarily students, they are graduates, and they are now working for well-known companies and lesser-known companies, big and small, around the country. So these are people who typically are a few years out of school, whether that's undergraduate program or a graduate program. And we find them in a variety of ways, but word of mouth is a key thing. So around 50% of our customers heard about us from a friend. So I think that shows the quality of the product. I mean, you're not going to tell your friends about something that was a bad experience. So we've worked very hard to make sure that the application experience and the simplicity and the customer care, et cetera, are very good. And then combined with the savings, our customers are saving on average $14,000 when they refinance with us. That service combined with the product itself is a very compelling mix. And that really has led to huge word of mouth that is driving a lot of our growth. And then obviously we supplement that with different forms of marketing, online and offline. And then we have also many partnerships with big employers, big and small employers around the country. So we help to offer our products to their employees as an employee benefit, and that's proven to be very, very beneficial for all parties.
Right. At what point in time did you start to get in institutional investors, and how did you convince them in the first place that your loan portfolio is worthwhile buying?
Yeah, it's a great question, because at the beginning, at the very beginning of the company, we would tell people what we were up to, and we would say, these are the types of people that we are lending money to. And many people would nod their heads and say, yeah, they sound like a great investment. And then you would say, well, okay, can we have some money, please? And they would say, well, why don't you come back in a year, once you've proven that these people can pay back their money. So it was, although we're relatively young, and it's 4.5 years, it was still a gradual process. So you would have to take small bite-sized chunks at the beginning, the real early adopters, the people that were willing to maybe go on their gut instinct a little bit more. But for many of the investors, we had to wait a couple of years until we had that track history, until we had that repayment history to say, okay, we now have X thousand people who have repaid their loans. Now will you invest? Now will you believe what we're saying? And it's a gradual thing. So we're at the point now where we have securitized many of our loans, many thousands of our loans, and those securitizations are actually rated by the rating agencies. So, there's some third-party validation that they have looked at the credit quality. So every time we do that, the rating gets slightly better. The amount of money that it costs us, basically to pay that investor, goes down, and we can then feed that lower cost of capital to our customers, to our borrowers, in the form of cheaper loans for them.
Did you try to find some kind of banks or institutional investors as an investor, equity investor, for example, in your company, with the argument, guys, I will offer you an investment opportunity, which is an option to having access to our strongly growing kind of loan portfolio? So
we did a bit of that. We've done a bit of that. We also, at the very beginning, many people, when we were going after individuals, many individuals were interested in investing in the loans, but that, in most cases is a kind of single-digit return. And they were more interested in the opportunity to invest in the company, because they liked the idea of what we were doing and thought that it could grow into a decent-sized company. So we had lots of people that said, I don't really want to invest in the loans, I'd like to invest in the company. So at the beginning, we kind of mixed the two and said, well, you can't invest in the company unless you invest in the loans. And that was one of the ways that we got people to commit capital to the loans that enabled us to start making loans, because obviously all equity capital on its own would not be very useful to us. So there was a bit of a trade-off there that our early investors were willing to go along with, because they believed in what we were doing as a company.
And did you only try to raise equity, or did you also think about venture debt?
We just raised equity. We discussed venture debt, but I think we preferred a kind of cleaner model. So it was equity all the way. Every round that we've done has been equity.
In terms of regional distribution of your customers, what is it? Is it only US focused, or are you also internationally?
So as of today, it's just US. It's across the whole of the US. It isn't just a West Coast business or a New York, San Francisco. We have customers in every state, bar one, because we have a license for each state. Internationally, we have considered that and we discussed that, and I think at some stage in our existence that will happen. It's not on the table today, right? At this point in time, just because of the opportunities in the US. But at some point, I fully expect that will happen.
Right now, you are a consumer finance company. Do you think it's easier to start a consumer finance business than, for example, a corporate finance, or let's say a business finance business?
I don't know if it's easier. I think here we sit here in Silicon Valley, in San Francisco. There is appetite, or there is acceptance of new types of businesses. So that among the consumers here, and I think in the US at large, there is a large group of people that will give new businesses a try. And I think maybe that's a little bit different to other countries where they want to see a name that's been around for 50 or 100 years. So I think getting new consumer business off the ground is possible here. And with new technology, it's getting easier to get the word out. there's pros and cons with that because everybody's doing that. It's so noisy and that sometimes you can't get heard. But you can, through social media and other places, you can get the message out. And if, again, coming back to the point about people referring their friends, if you can create a product that people like, it's easy for them to tell their friends now. There are review sites online, people put things on Facebook and tell their classmates, maybe there's 400 people in this Facebook group, and someone will say, hey, I took a loan with SoFi, you should check it out. That kind of thing didn't exist before. So I think going to businesses it's more binary. You've got big ticket partnerships or deals, but if they don't happen, then maybe you're in trouble.
Right.
Whereas with consumers, it's a bit more gradual.
Dan, what is your advice to first-time entrepreneurs?
I've seen a few people try to start companies out of business school, and I think the idea that you have has to be fundamentally different from what's there today in the market. Because if it's only a few percent better than what's out there today, the chances are you'll hit an obstacle that will be big enough that you may not get over it. I think to be able to get over those obstacles, you have to have an idea that's almost 10 times as good as what the market currently has, because inevitably you'll hit those obstacles, and you need something that's big enough that people think it's worth going for, it's worth jumping over that wall to get to. And to get financing, people, they need to see something that is very different from what is out there today, and not just a subtle shift. So I think having a big idea and making sure that idea is significantly different from what's out there today. I mean, that's easier said than done, but I think that's the best advice I could give.
What other type of advice can you share? Some of the learnings maybe over the years?
I think it's tough at the beginning to get everything right, so you shouldn't expect to build the perfect product, or you shouldn't expect to have the perfect customer experience straight away. Now, of course, you want to get there as quickly as you can, but I think in most businesses, if you wait too long, you may have missed your moment, or you may run out of money, or you may, by trying things and sometimes not succeeding, you learn. Now, you don't want to do that all the time, but you can't wait for it to be perfect. And I think that's something I've learned since I've been here, in Silicon Valley and in the US in general. It's try lots of stuff, and sometimes it'll work, sometimes it won't. But don't be afraid to fail. And if you can fail small along the way and learn from that, I think that you can refine and improve your product and to something that people really do want.
Great. Dan, thank you so much for sharing your knowledge.
Martin, thank you.
And good luck with SoFi.
Thank you. Good luck to you.